The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Foat.
And I'm Shonali Bassick. We're kicking you off to the closing bell here in the United States. Let's get a check here on where markets stand because it is a tough tape out there. 0.6% lower on the S&P 500, and that is not session low, but it is pretty close to it. The Nasdaq 100 selling off further about 0.8%, even more so in the Philadelphia Semiconductor Index, about 2.6% lower. Russell 2000 down on the day about 0.6%, but I will say, Scarlett, it is still up on the week.
It is still up on the week, and that is part of the market themes we'll get to. But really, top story is recovering from a global IT failure. You have industries from airlines and banks to retailers and healthcare systems trying to get their computer systems back on track after a botched cybersecurity software update from cybersecurity firm CrowdStrike crashed countless computer systems around the world. The CEO telling the Today Show what went wrong.
The system was sent an update, and that update had a software bug in it and caused an issue with the Microsoft operating system. And we identified this very quickly and remediated the issue. And as systems come back online, as they're rebooted, they're coming up and they're working. And now we are working with each and every customer to make sure that we can bring them back online.
Market volatility returns. Stocks end a wild week on a downbeat note as investors continue to rotate out of this year's best performers, tech, and into laggards like small caps, REITs, and financials. And impressed by Trump, Mark Zuckerberg joins a growing chorus of Silicon Valley bigwigs who are warming to the former president. We'll share the Meta CEO's exclusive comments later in the program. But first, CrowdStrike making news for all the wrong reasons. Shonali, this is certainly something that we're keeping an eye on.
We certainly are, because it is impacting the stock. It's also impacting a lot of business across the country, across the globe, really. You're looking at McDonald's, JP Morgan. Traders woke up to not being able to go to their desks sometimes in Hong Kong. Nintendo, Delta, Bank of America, American Airlines, the airline stocks very much impacted here. FedEx, UPS having to delay deliveries. Scarlett, almost everywhere you look, there has been an impact with this issue.
Absolutely. That long laundry list is just kind of the beginning, the tip of the iceberg. So let's kick things off here with an expert in cybersecurity and bring in Dave Berg. Dave is global head of cyber risk over at Kroll. And Dave, you heard the names, the list of industries that Shonali went through. Why were so many industries affected?
Well, first of all, thank you very much for having me. This clearly is a large system outage that I think is attributable to two key factors. One, you have likely the most commonly used operating system in the world is involved, as well as one of the most valuable cybersecurity companies in the world involved. And so where you have a confluence of these two very large players and an outage, which most companies of all sizes, from the large logos that you see on the screen today to small companies all around the world, rely on these technologies and were affected by the outage which occurred.
Yeah, obviously any company that uses or relies on Microsoft operating systems could be at risk here. So what does it say about the industries or companies that were completely unaffected? Was that luck, or did they perhaps diversify their choice of technology infrastructure?
I mean, I think this has a lot to do with the combination of technologies that were selected. I mean, so first and foremost, system outages occur and have occurred for as long as we've used technology systems and likely will going forward. It happens. This has happened before in the security industry with security products. And so, yeah, I mean, the reality is those that were unaffected had, for this instance, perhaps the right mix or the right flavor of software running in their environment. And if they were unaffected, in fact, in this case, it would be purely circumstantial.
Dave, given the scope here, we've seen how many industries being impacted, how many companies. You think FedEx, UPS, talking about deliveries being delayed, thousands of flights being delayed or canceled. And you look now, what are your clients really saying to you at this moment? Is there a loss of business here that they need to be compensated for? Who compensates for all of it?
So I think what's really interesting about this matter in terms of the recovery time, and this is, look, we will systemically, we will recover from this event. It will take time. Part of the reason for that is that you have computer systems of all different variety distributed all around the world. And also, we have workforces and remote workers that are working all around the world. So unfortunately, the fix that is required here does involve some manual intervention, which means that this may take longer in time to resolve because technicians may have to physically have access to the computing environment as opposed to pressing a button and really having all of the systems reset themselves and resume normal operations, which leads to the second part of your question, which is really the large and significant factor around this outage is business interruption. And understanding and quantifying the damages that come from business interruption are a very big deal and will likely take far longer than the amount of time it will take to recover from this outage.
So when you talk to your clients now, what do they want to know from you? If you can give us some sort of anecdote on what people are looking for.
Really what they're looking for is they want to know how do they fix this problem. So what's important is that CrowdStrike very quickly published a remediation guide that described the issue and described the fix. So what our clients are asking us to describe is how do we implement this? How are others implementing these kinds of remedial steps efficiently, broadly, and as quickly as possible? The other question that's being asked is, how is the business ecosystem affected? And what I mean is if Company A is not affected, but Company A relies on Company B, C, and D. If Company B, C, or D has an outage issue, they want to understand how does that outage affect their business. And so that's a very important component part of this. This is not necessarily, and even to your very first question, a question of whether or not the company itself is affected. It's really a larger question of how does the business supply chain, how does the connected business ecosystem, how is that ecosystem affected when sub-parties or third parties that are relied upon have an outage? And so our clients are really trying to understand the full picture right now, and we're working to try to help them understand and address the full picture.
Messy daisy chain reaction going on, and of course a lot of implications across businesses across the globe. We thank you very much. That is Dave Berg, Global Head of Cyber Risk over at Kroll. Now let's dig deeper into the potential ramifications for CrowdStrike. Now with shares down about 13%, Greg Moskowitz, Managing Director and Senior Enterprise Software Analyst over at Mizuho Securities, he has an outperform rating and a $370 price target on CrowdStrike. One thing that struck me this morning was how widespread these issues were. Of course, there were issues when it came to CrowdStrike as well as Microsoft, yet that's just two companies impacting global businesses around the world. So when it comes to businesses and their work with CrowdStrike, how sticky is it, Greg? Do you think that people have options to turn away given what just happened?
Well, thanks, Shanelli, for having me. It's good to be here. And yes, there are alternatives. So the leading pure play provider in this space is clearly CrowdStrike. In fact, they're the leading player overall when it comes to endpoint security and some of the various areas surrounding that they also provide. From a pure play perspective, another company that does exist is SentinelOne, and certainly that represents an alternative. Microsoft has Microsoft Defender, which they've carried for many years, and then there are several other companies as well. Having said that, it is important to emphasize that, again, CrowdStrike is the leader in this space. They have nearly 30,000 customers, and certainly a lot of the most blue chip customers in the world. And you highlighted some of them that unfortunately were affected by this issue, obviously. But so yes, you can move from one vendor to another, but CrowdStrike is also known and widely regarded, I would say, as having the most effective solution in this space. And it is also important to note that while this was obviously a meaningful error, a significant step, this was not an actual security incident. It wasn't a breach per se.
Right.
And so from a confidence perspective, that's also kind of worth noting here.
Okay, well, that's good to just put that into context here. But I wonder what kind of cost this will leave on CrowdStrike's financials, if at all. The company doesn't report earnings until August 30th, so that's another 5-6 weeks before we formally hear from them. Do you anticipate getting any kind of pre-announcement just on the impact or an estimate of the cost?
So I think Dave put it well. I think having an estimate of the costs at this point, or at least in the very near term, is going to be difficult. I'm not sure we're going to get anything. And in fact, I doubt that we will get anything prior to CrowdStrike reporting. I will say that having gone through the T's and C's, the terms and conditions, we don't believe there's any broad scale liability per se as a result of this. However, as you pointed out at the very beginning of this show, there are some large businesses that have been significantly disrupted. And so our expectation is that, certainly there will be some concessions and some revenue impact, but way too early to be able to quantify that. I will also say, having followed CrowdStrike for a long period of time, we have not experienced, any issue previously with respect to them getting breached or with respect to an outage. So there has been a lot of goodwill that's been accumulated. Now, obviously, it's important, very important, that CrowdStrike does right by their customers and that they continue to remain very communicative around this. And of course, that we don't see a repeat issue along the lines of what happened, unfortunately, over the past day or so. If all of that holds true, we would expect customers to, by and large, move on and to continue to view CrowdStrike as a very valued security company.
The T&Ts, you kind of mentioned the terms and conditions, or T&Cs rather, terms and conditions here. When you think about the liability, explain that a little bit more, because if you're a business, if you're a FedEx, for example, or a Starbucks, or anyone who's experiencing the lack of business continuity today, how do you gain recourse? Do you expect anyone to sue?
That's hard for me to sort of predict how each company or how companies in general will respond to what has occurred. But as it relates to the T's and C's, it typically relates to or is tied to a security incident. And since what happened here was an update issue, an outage, as Dave said earlier, unfortunately, these things do happen in the industry, as regrettable as they are. But it does not, sort of adhere to a liable action, broadly speaking, where it would be in violation of a warranty or as contractual. So that is our understanding. Again, I do think that CrowdStrike, likely will make concessions to companies that are valued customers that have been highly impacted.
Got it. Greg, really appreciate your joining us on short notice. Greg Moskowitz, Managing Director over at Mizuho Securities. He's got an outperform rating on CrowdStrike. Now, coming up, tech earnings season is ramping up. We've got Alphabet, Tesla, and IBM reporting all next week. We're going to break down what the results could mean for the direction of the overall market. Sherry Paul of Morgan Stanley will be joining us.
Plus, shares of American Express are falling on the back of the credit card company's latest earnings results. We'll explain more on what's fueling the decline. It's today's Stock of the Hour.
And Accenture getting an upgrade from UBS on its AI potential, setting those shares higher. We speak with the analyst behind that call in Top Calls. All that and more coming up. This is The Close on Bloomberg.
Tech earnings ramping up next week with the results from the likes of Alphabet, IBM, and Tesla. Here to help walk us through how the reports could move markets, of course, is Sherry Paul, Private Wealth Advisor and Senior Portfolio Manager at Morgan Stanley Private Wealth Management. And Sherry, there was a lot of risk in this week's market. If you think about it, there could be even more risk next week's market as well. If you think about the political versus the earnings story, how do you really shake off this kind of risk-off sentiment going into perhaps the most important part of earnings season?
Well, first of all, thank you guys for having me. It's great to be with you. I think right now, when I think about advice to clients, is that they tend to sort of politically overreact and policy and earnings underprepare in moments like we've had this week. It's been a huge week between IT, global, outages and the RNC and, all of these different changes that are happening in the United States. The way that we think about this is we want to go right down the middle. If we've got good earnings, then great. And we see better than expected earnings, I think, than most people do. So we want portfolios to be centered on enduring thematics that transcend, party politics. And that would continue to put you into AI. It would put you into the installers, the adopters, the defenders, along with healthcare and some selective financials. And we've been rotating clients, which we started to do a couple months ago, into small caps just based on valuations and expectation for rates cuts.
Sherry, how much is this going to be a show me quarter for the big tech companies, which had been doing very well up until the last week or so?
Well, it feels like every quarter right now is a show me quarter for tech. But with that said, we are in like an enduring industrial revolution of transformation. And so with that will come enhanced volatility. I mean, if you look at the beta of the tech sector a few years ago versus where it is right now, it's appropriately reflecting increased volatility for this moment of transformation that will get reflected, I think, in uneven earnings. But what we're looking for is that long-term trend. And I would really encourage investors to continue on the journey. And if they're concerned about volatility, then to anchor their portfolios with more stable income providers within, consumer staples and healthcare.
It's interesting. We're speaking on a day where we see for the end of the week, the Mag 7 down together roughly 5%. And when you see moments like this kind of shaking off of the big tech names from a lot of folks on across Wall Street, do you see this as a buying opportunity, given where you think earnings are headed?
Yeah, I think for clients that have been sitting in cash accounts, I think there's $6 trillion of cash that these moments represent buying opportunities. If you're looking to rotate out of, what invariably will be an income cut in cash, as we believe that rates will decline over the next, 12 to 18 months, and to move into growth stories that can help hurdle over inflationary themes, which we're trying to address in this current Fed, but also given a shift in, political parties, we may see unexpected inflation on the back end in the form of unintended stimulus through either tax cuts. So I would encourage investors to sort of think more broadly. And so, yes, I would view these as a buying opportunity, including buying dividend-oriented companies that might be, in a moment of setback, particularly around this IT issue.
I know you've said several times that we are at peak rates right now. And of course, we're all waiting for word from the Federal Reserve on when they're actually going to begin their cutting cycle. So preparing your portfolio for a declining rate environment is important. To that end, how do you prepare? Is it when you actively prepare, are you talking about implementing some of those decisions to start buying, like you said, income paying stocks, or is it more getting your ducks in a row?
Well, I think it's actually all of the above, Scarlett. I'm so glad you asked that question because we're entering a cycle of declining rates, which means cash accounts and the income goes down, but we're also in a historic cycle of dividend increases that are occurring within the market. So our advice to clients is to include within a portfolio the pay increases of dividend growers, in addition, though, to adding and anchoring into growth-oriented thematics that might bring more volatility, but also will enhance returns again to kind of help ascend over these inflationary themes, which may be more challenging, I think, than people realize. Because I think people forget that just because the Fed cuts rates doesn't mean that prices go down. Yeah, it just means that inflation is slowing, very different. And energy and food prices are outside of the preview of how the Fed views, the inflation figures. And so those things could continue to be challenging.
Yeah. The inflation arrow is still up, even if it's up a little bit less than before. Sherry, really appreciate you joining us. Sherry Paul of Morgan Stanley Private Wealth Management there. Now, coming up, we're watching shares of American Express, one of the big decliners in the Dow, after the company says it is spending big on marketing, even as billings slow down. That is today's Stock of the Hour on The Close. It's It's time now for today's stock of the hour, and we're watching shares of Amex, the stock under pressure after the company reported slowing billings growth and marketing costs that are expected to jump 15% this year. Abigail Doolittle has more. So I guess this is more about investing in itself because of the slowing billings growth.
Maybe, although this is interesting. So I've been informed, educated that these headlines might be a little bit misleading, only from the standpoint that they were already spending these marketing costs. So in the first quarter, they had already notched $1.5 billion, which adds up to the $6 billion for the year now. It is quite a bit, 15%, but they're really standing by it, saying that they see an opportunity for their demographic to really grow cards in this slowing environment. In particular, they're really going after what I would call the younger person, millennials and Gen Z. I guess I'm dating myself a little bit. But the CEO, Stephen Squeri, said millennial and Gen Z is still the engine. We've unlocked an entirely new segment for ourselves over the last few years. So they want to invest in this in terms of new perks for their most popular cards, including the gold card. You get to go into, I've certainly used a lot of those perks in the past, less so more recently. But, there is something about those cards when they do it right that makes you feel good. And it sounds like that's what they're really trying to capture.
To talk about the 173 billion pound gorilla in the room here. Because, Amex is Amex, right? Amex has been a winner for a very long time. But to talk about that revenue miss for a second here, what really drove that? Because we're sitting at a very sensitive time here for the card industry. People worried about consumers' ability to keep maxing out their cards, particularly those younger consumers. And frankly, Amex has been on a tear. They're giving up some of those gains right now.
Yes. So in terms of that miss, I think that there was just a little bit of weakness in the spending there. And that has been the trend for credit cards overall, that consumers are spending a little bit less. But relative to the stock, the reaction to that miss, which is not huge, this stock had been up in a big way. And from a valuation perspective, I'm just trying to find these numbers right now, at a 50 to 60% premium PE to the peers. So basically too far, too fast, and not quite delivering the perfection that maybe some had wanted, that in the long-term aspirations for the 9 to 11% revenue growth. Some analysts, at least the one that I spoke to here at Bloomberg, is saying that that really is still intact. So he at least is seeing it as a little bit of a blip, but the stock reaction to it has more to do with, again, that the stock had been up quite a bit.
Yeah, that's a really good point. The context is always appreciated here. But I want to go back to that idea of really banking on the millennial and the Gen Z customer. And as a fellow Gen X, I understand they are the younger demographic. We know that Amex has really been trying to build out its focus on travel and leisure during the quarter. They've made a number of acquisitions to that end.
They did make the they did make the one acquisition, and bear with me, I'm just pulling this up as well, to try to boost that as you're talking about. And
I think it's Tock, right?
Yes,
$400 million?
I'm pulling this up right here, $400 million, and basically does focus on that travel and leisure for the younger folks. It offers reservations, table management, and event ticketing to around 7,000 restaurants and other entertainment outlets. So it complements the goal. What makes that interesting is the one area of weakness that they sort of highlighted in this past quarter was discretionary spending around travel.
Yeah.
So this actually would seem to be that discretionary spending, so it's going to come back to the consumer.
It will also be interesting as we continue to watch those travel stocks into the earnings season. Abigail, we thank you so very much. And coming up, we're going to wrap up bank earnings this season with Zach Wasserman of Huntington Bancshares. Stick with us. This is The Close on Bloomberg.
It is just about 3:30 p.m. in New York. This is the Countdown to the Close. I'm Scarlett Fu.
And I'm Sonali Basak.
And of course, bank earnings season for the big banks is over. For the regional banks, I think we're about halfway through. And by next week, we should be done with the rest of them. But so far, so good.
It's interesting. About a year ago, we were watching these banks because there was a lot of trouble in the system. This year, we're watching the banks because people are looking to bet on them hard. And the KBW Bank Index is certainly one of the places you are seeing a lot of love in a market that has had some significant malaise this week. The KBW Bank Index up about 3.7%. I will also say that includes most stocks seeing gains. There is dispersion, though, in that market, I've got to say. For example, today alone, Comerica down more than 10%. But by and large, a lot more love coming into the system.
Yeah, Comerica is now the worst performer for the week as well because of that big loss.
Tough. But we're going to talk about a positive story. We have net interest income growth, a key factor for banks this earnings season. Huntington Bancshares affirmed its forecast for the full year in the morning's second quarter report. Credit quality and loans also remain stable for the lender. And as you can see, the stock has been on a rise this month. Joining us now for more on the performance is Zach Wasserman, Senior Vice President and CFO of Huntington Bancshares. And if you think about this story, about how much weakness there has been in the regional banking system and the opportunity presented now, even in the face of tighter capital rules, what kind of opportunity does potentially lower interest rates now provide you?
For us, it's going to do a couple of things. One, it'll allow us to continue to drive a really high level and a stable net interest margin, while also supporting our continued loan growth and just supporting the broader economy to facilitate that. We were really pleased today to report, as you noted, a strong growth in net interest margin and net interest income. For us, one of the key elements of our plan has been to see that revenue stream hit a trough in the first quarter and begin to grow into the second quarter with an outlook to continue to grow for the balance of the year. We delivered that, and we expect to continue to drive that growth out into the future.
So, Zach, you mentioned loan expansion. Your firm is optimistic on loan expansion. You see it rising 3 to 4% this year versus, let's just say, a more subdued view over at your peers. Why is this? What do you see that your peers don't?
It's interesting. I just was analyzing the results of the 9 largest regional banks that were reported, and only 3 reported loan growth, and Huntington was the fastest of all of those. And, for us, we've been leaning into growth now for several quarters. Huntington is in a position of strength in terms of capital, credit, and liquidity, which is allowing us to really be in expansion mode. A couple of things are going on. One is our core business really expanding well. We're seeing loan growth in commercial and consumer segments, but we're also launching a number of new growth initiatives. Earlier this year, we launched our business into 3 new states, the North and South Carolina and Texas. We've also launched 5 new commercial businesses. So it's really, for us, the combination of core and new growth initiatives that are fueling that.
Zach, I do have to ask you a little bit of a political question here because, of course, you've seen the betting odds of a Trump presidency rise coming into this week, and there's been a big expectation underpinning the surge in bank shares this week. Not just that lower interest rates would help, but a Republican administration could help loosen these capital rules, maybe allow for more deals in the industry. Do you see it that way?
For us, we're focused on what we can control and what the economic environment is and what we're seeing on the ground in our footprint states. And, we operate mainly in the Midwest. We've certainly got national businesses, but a lot of our business is focused in our core Midwest market. And what we want is a healthy economy there and for good governance that'll help to drive economic growth and to support all of the customers that we're focused on.
I need to ask you about commercial real estate because after the regional banking turmoil last year, that was always seen as the next shoe to drop. You have very limited commercial real estate exposure, especially when it comes to office properties. First of all, how has this evolved over the past year? And therefore, is CRE an opportunity potentially for you, especially once the Fed starts cutting rates?
CRE is an attractive segment over time, over the course of an entire rate cycle. Clearly, at times like this, when rates have increased a lot very quickly, it's challenging, for new origination and just for developers to find profitable new growth. And certainly the credit topics that have been up in the mind of many over time here. So I think over the course of the next several years, I do think there's an opportunity in commercial real estate. For now, what we're seeing in our portfolio is a net reduction. We just discussed today with investors, we're down about 10% year on year in commercial real estate. And interestingly, it's not for lack of trying of origination. We're really just seeing relatively low levels of a new origination and a fairly consistent level of pay down activity. So overall, looks actually pretty healthy and consistent with what many, I think, of saying is that this is going to be a long process of that industry normalizing and adjusting to the new rate environment.
Well said, Zach. Really appreciate your joining us today. Zach Wasserman, Senior Vice President and CFO of Huntington Bancshares. It's really interesting because they've done a good job in terms of holding on to their depositors. And we know that people are desperate to continue to earn the kind of returns that they've gotten in their money, especially when they stock it away in cash in their bank accounts. And so, how do these banks make sure that they don't give up these depositors?
It's fascinating because that deposit push has been huge among these banks, and it has really been expensive in a lot of ways.
Yeah.
But the thing is, what happens when rates come down? Will people still be borrowing at the same clip, given that so many people are maxed out? One thing that really interested me, Scarlett, was he was kind of talking about that rising net interest income as a percentage, like a league table, right? We rose this much compared to the other banks. It just shows you how closely these banks are watching each other, too.
Yeah, the spreadsheet is always being updated, right?
Totally.
Coming up, IT company Accenture at the top of its game and still has some room to run. Next in Top Calls, we're going to speak with an analyst about why he's bullish on the stock. This is The Close. It's time now for our top calls to look at some of the big movers on the back of analyst recommendations. And first up, SunPower feeling the burn after Guggenheim slashed its price target to 0. Alongside some brokers who suspended coverage of the company, SunPower recently announced it was halting solar installations and shipments. Guggenheim says it effectively marks the end of SunPower as a business and called the move a sad end for an industry pioneer. The stock off by 57%. ARM Holdings next in line, the chips and software designer getting a boost to overweight from Morgan Stanley. Analyst Lee Simpson highlights potential gains from ARM's growth in the edge AI space. He also sees smartphone royalty growth led by a strong iPhone upgrade cycle and opportunities in the auto space as well. The stock up by more than 3%. And let's end things on Accenture, an upgrade to buy from neutral over at UBS. The analyst says the IT services company stands to gain increased revenue optionality from generative AI. Shares up 0.5%. And those are some of our top calls. Now, we're happy to have the analyst behind that call join us right now, Kevin McVeigh. He is managing director at UBS. Kevin, it's good to speak with you. Your take here is that the stock is not pricing in the extent of Gen AI optionality. And you point out that Accenture had booked about $2 billion in Gen AI bookings in the fiscal third quarter, as opposed to $300 million for all of the previous fiscal year. When we talk about these Gen AI bookings, are these one-time billings or recurring billings?
So, and thank you for allowing us to be here. It's a pleasure to be here today. So those are the bookings that come in advance of the revenue. And what you've seen is the Gen AI is scaled, to your point, 300 million of revenue in 2023. You've seen an acceleration of that in 2024. What drove us to upgrade the stock was we don't think the market is adequately discounting what that potential can be and the revenue acceleration associated with it. And what you've seen happen as a result of that is some of the unevenness over the course of 2024 has caused some volatility in the stock, and we thought that was a real nice opportunity to upgrade the stock to buy from neutral.
Well, speaking of the fact that you were neutral just before this decision as well, kind of what took you to get here and what risk is remaining in this view?
Sure. So, we were really monitoring the pace of the Gen AI bookings because it's been such an important indicator for not only the stock, but the broader market. And I think what had happened with Accenture earlier in the year was it had discounted a pace of revenue associated with the Gen AI based on some of the success that their alliance partners had that have become slower to develop. But as we look at those bookings over the first 3 quarters of the year, and we look to model that out into 2025, we think, the stock needs to start calibrating that more. And, that's really what drove the decision to upgrade the stock, particularly given the progression of the revenue. What you've seen happen is, decelerating revenue over the last 2 or 3 years. And as we start to see that inflection point, which based on our model suggests their Q4, which is August, which they'll report next quarter, will be the inflection point in the revenue, and then we'll see some rate acceleration over the course of 2025. I think the biggest risk to this call is really if that gets extended. What we tried to do was really look at past inflection points, and the one we really leaned into as part of this exercise was the inflection point in their cloud business. And if you go back and look at that relative to where the stock is today, it proved to be an opportune time to recommend the stock.
So one thing you point out is that clients have been experimenting with Gen AI. How much do companies spend when they're experimenting versus a full-scale deployment when they actually come to that decision?
So it really depends. On the experimentation side, what you're seeing is they tend to be smaller scope projects as opposed to full-scale implementation. And you can see that borne out in the pace of the bookings because there's been a fair amount of disconnect between the pace of bookings at Accenture relative to the revenue run rate. So when you think about, and again, these are overall bookings as opposed to the GenAI bookings, but what you see is particularly the 300 million or so that occurred in 23, that felt to us like it was more experimental proof of concept because GenAI is such a novel idea and they have such terrific clients, Accenture does, that they need to learn kind of what it means to the organization before you can do a full-scale implementation. And it's such a complex and exercise that it's the experimentation that ultimately leads to the full-scale implementation. But until you really know what the needs of the organization are, it's really, really difficult to kind of become aggressive in a full-scale implementation.
Got it. Well, thank you for bringing this all to our attention. Kevin McVeigh over at UBS with his upgrade on shares of Accenture. We do have some breaking news that we want to get to. The Federal Trade Commission, the FTC, is looking into Hess and Occidental Petroleum and Diamondback Energy. They are investigating whether executives at these major oil companies perhaps improperly communicated with OPEC officials. They're looking for evidence that these executives attempted to collude with OPEC officials on oil market dynamics. And this is according to people familiar with the matter. So you're looking at shares right now, Sonali, of Hess, Occidental Petroleum, Oxy is the ticker, and Diamondback, all down right now, which is, kind of in line with where the broader market is, although these declines are obviously much larger than the S&P 500.
Yeah, they are larger. And then on the back of that also, remember, energy is an industry that has been absolutely tearing apart this week, winning among other industries. So a painful trade for investors.
All right, coming up, we're going to continue to count you down to the closing bells with Steve Sosnick over at Interactive Brokers. This is The Close on Bloomberg Television. All right, we do have some breaking news. Let's just repeat it for you. Bloomberg is the first to report that the U.S. Federal Trade Commission, the FTC, is now investigating whether executives at major oil companies, including Hess, Occidental Petroleum, and Diamondback Energy, improperly communicated with OPEC officials. Let's bring in now Bloomberg's managing editor for energy, Simon Casey. So, Simon, that language does not sound good. To what extent could it be illegal under U.S. antitrust laws?
Well, OPEC is a cartel. It's been around for decades now. It's a sovereign entity, but U.S. companies are essentially banned from being part of that cartel, and that extends to they have to be very careful how they communicate with them. And as our story explains, the FTC has been looking deeply at this. It's been looking through text messages from phones possessed by executives of those companies. This comes on the back of, if you cast your mind back to the story earlier this year about the merger of ExxonMobil and Pioneer Natural Resources as one of the big oil deals in recent years, the FTC was reviewing that. Mm-hmm. One of the conditions for approving that deal, the companies agreed to exclude Pioneer's founder, Scott Sheffield, from the board of the merged company because they found that he had had communications with OPEC members that came to light as part of the FTC's investigation. So this is in a sort of similar vein, and it looks like what's going on here is they're looking further into this theme, if you like, this idea that other executives may have been engaged in similar communications.
The agency is looking for a so-called smoking gun to be able to refer a shale cartel case to the Justice Department. Simon, we thank you so very much for your time and your reporting. Of course, mergers and acquisitions were a huge case for investment in the energy industry. Of course, the three stocks, Hess, Diamondback, Occidental Petroleum, all lower on this news. And for more market analysis, we're going to now bring in Steve Sosnick as well. We're going to talk here about the broader markets here, because even though energy was a bright spot heading into this week, a little bit of a rough patch now, you are seeing losses across the screen, really, in every sector, particularly in tech. Steve, how do you feel?
Well, First of all, good afternoon, Sonali. It was definitely a week that I was calling this, it was real rotation. And this was kind of the rotation out of the big cap techs into other sectors. The energy stocks did a bit better because that's perceived as being a big beneficiary of the Trump trade, which also was one of the factors this week. Today is almost like a get me out of everything kind of day, because we're selling across the board. It's still not a rout. This week we never saw like one of these 8-to-1 decliners over advances kind of days. They've always been relatively modest. But today it's pretty much across the board and pretty much unrelenting. And this late piece of news is definitely not helpful to the people who went into energy.
But like you said, nothing disorderly up until now. This rotation out of tech, I mean, even if it's not disorderly, it's definitely happening. And the rotation into small caps, do you still see evidence of that? I mean, the Russell 2000 is lower today, but it's down less than the S&P 500.
Yeah, and that's been the case, Scarlett, a couple times this week. But, first of all, we had one of the days where there was the big, I called it the routation, because there was just get me out of big cap techs and get me into everything else. But that's kind of faded out a little bit. And what's been my fear all along, and to me, why I've been a little bit nervous about how concentrated the leadership has been, is if people want out of those sectors, it's going to take the market down with them. This isn't even psychology, this is just mathematics. It's a third of the S&P 500 and half of the NASDAQ 100. So if those stocks get hit hard, if people just say, I want to take some profits in those, you can't hide. And that eventually spills back because people look at the S&P and go, oh, it's getting hit hard, even if the broader market is not doing so poorly.
But is that all we're seeing, this idea of profit taking? Or are we seeing a change in sentiment, something that's a little more risk off just as we hit that really critical moment of earnings season next week?
We are, and it's interesting because before this started, I noticed instead of the usual rally from 3 to 4 o'clock, maybe it's the show that does it, but everything.
Thank you. You're perfectly rosy, Steve.
Exactly.
Come on.
So there's that 3 o'clock rally. Even before this started to break, you started to see selling in the last hour of the day. So that was a bit of a different character. And so also what I noticed was, we had, I'm a VIX volatility person, so we had VIX at 12.5, and people were saying, oh, it's major complacency. And I looked under the hood, basically, and it wasn't, because the historical volatility of the S&P 500 was so low and correlations were so low that you should have had VIX actually at about 9 or 10. So it told me that there was a bit more risk aversion being priced in than it appeared. And of course, now with VIX, 16, 17, that all of a sudden looks like the risk aversion's come to the fore.
Yeah, VIX has risen every single day this week. And as you mentioned, now at 16.6. So next week, we have really big tech earnings come to fore. What do you think is the positioning heading into this tech earnings season?
The positioning, and I think that may have changed over the last couple of days, has been everybody all in all the time. And that actually is to me one of the bigger risk factors. And I think that's probably why you're seeing VIX go up, because remember, VIX looks 30 days ahead. Big events being mega cap tech and the FOMC meeting in the next 30 days. Market sort of paid attention to that. But my fear is a lot of times we've seen good news and these stocks sell off anyway, because I think about Micron really being the bellwether for this, where they beat pretty much on every metric, except they didn't beat the whisper number on future growth, and then they hit the stock. And so I do think that there's all these like super hidden expectations out there, and that to me is the biggest risk factor as we go into the mega cap earnings next week and the following.
I love that. All right, the whisper number for something as erudite as the future billings, not even like the top line or the bottom line or the margin number, right?
Exactly.
Steve, really appreciate your joining us. Steve Sosnick, Chief Strategist over at Interactive Brokers. Have a great week.
Thank you, Scott.
And weekend, I should say, as we all gear up for earnings next week.
What is the safety trade, though? Can I tell you something? Like, gold is down 1.9%. Two-year yields are up about like 4 basis points to 450. Where are people actually buying today? To Steve's point, this is a weird last hour.
Well, Bitcoin is up about 5.4%. I realize that's not a big move for Bitcoin, but
even I'm rolling my eyes at that. But yes, what is the safety trade? All the things that are unsafe at all, some things that are out of this market.
The dollar, strong dollar.
Strong dollar, strong dollar.
Strong dollar is a reliable one, right? You are looking at a lot of red arrows right now. We can see the S&P 500 losing 0.8%. And as Steve Sosnick was pointing out to us, in the previous weeks, we had seen stocks kind of rally into the close. That's definitely not happening here as indexes kind of swoon into the close. You have the NASDAQ 100 losing even more ground, about 1% lower. And the chip makers in particular have been under pressure. NVIDIA, TSMC came out with a decent revenue upgrade for the full year, but that didn't do very much for the stock, especially with all those geopolitical concerns and the White House positioning for perhaps more chip export restrictions. All right, let's get you closer to the closing bell right now. We're going to bring in our colleagues from radio because we've got full market coverage right here on Bloomberg Television with our colleagues over at Bloomberg Radio.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day on this Friday. Scarlett Fu and Sonali Basak here. And of course, here to help us take you through the closing bell, we've got a global simulcast. And that means Carol Massar and David Gura in for Tim Stanovic joining us. And of course, by doing so, we bring together everyone, Bloomberg Television, Bloomberg Radio, and our YouTube audiences as we look at what's going on here. And Carol, in the final minutes before the closing bell, as Steve Sosnick was just telling us moments ago, it's a change from what we used to see, which is a bit of a rally into the close. Now we kind of have these swoons into the close.
Yeah, absolutely. And, swoon is the right word for the week. I'm just thinking of the NASDAQ 100. It's down, about 4% this week. So definitely we talked, right, David, about this rotation out of some of these big cap tech names. We definitely saw it in the trade overall this week.
Yeah, Carol, just picking up on that, I mean, this has been an exhausting week. We've spent a lot of time talking about that over the course of the show today. But, we started with new comments from the Federal Reserve Chair. We saw, obviously, former President Trump on stage in Milwaukee talking about his plans for his second term. We saw the kind of resurgence as a result of that of the so-called Trump trade. So a lot has happened here over the course of the week. And I'm particularly interested in sort of what we've seen in technology stocks in these last couple of days.
Last couple of days and this week to end the week, really, this risk-off tone is pretty incredible. And if we were trying to look across the markets for a haven bid, and we could not find one, guys. I mean, maybe a little bit in the dollar. You see Bitcoin rising. Gold is down 1.9%. Even the 2-year is down. There is some serious risk-off attitudes going into this weekend. Political uncertainty and, of course, earnings uncertainty as well into next week.
Oh, Sonali, you just rolled your eyes at me when I mentioned Bitcoin earlier. We do have healthcare and utilities somewhat higher, so I guess that could be a kind of a place to find some safety. We know that those are dividend payers as well, so that provides some comfort. But look at that closing shot of the market right now. You have a lot of red arrows and pretty big red arrows too when it comes to Dow off by 0.9%, 40,290. The S&P 500 losing 0.7% at 5505, and the Nasdaq lower by 0.8% at 17,726. Worth pointing out as well that the Russell 2000 did finish lower on the day, but its decline is less than its big cap brethren. So off by 0.6%. Perhaps because of that, the rotation is still kind of on?
Kinda. We shall see. But yeah, kind of interesting to see how it ended up. I'm going to go back to the big caps for a moment and just the S&P 500 today. And Sonali had most names in the index lower, about 367, 134 actually gaining some ground today, 2 unchanged.
And if you take a look at sectors here, it was pretty broad-based. You did have a little bit of green on the screen, as Scarlett was talking about healthcare stocks, utility stocks a little higher on the day, but really that was on the back of some earnings that we saw out of the healthcare sector that helped drag that part of the index higher. But energy, the biggest loser here at 1.3% out of the sectors, is pretty stunning when you have a week where energy was the biggest gainer in the middle of what was, frankly, a Trump trade.
Yeah, that was a lot of red that I'm looking at the screen right there for those of you who are listening on radio. Let's get to some of the individual gainers, if I may. Starbucks, right? We had a headline just about 2:40 Wall Street time today. You've got activist investor Elliott taking a sizable stake in the company, pushing to find ways to boost the stock prices. Come from the Wall Street Journal, citing folks familiar. So you saw a pop in shares of Starbucks up almost 7% in today's trade. A top gainer moving along to one that really was a standout in both the S&P 500 and the NASDAQ 100, talking about Intuitive Surgical, tickers ISRG, finishing the day near its highs, up 9.4%, initiated with an outperform and $21 price target over at Wedbush, which said the shares seem undervalued. So we did see certainly a big move. Oh, forgive me. That was Canadian Goose. Oh, mixing up my notes. Hang on.
Take your time. Take your time. It's Friday.
That's because I added Starbucks. Hitting a record. Company second quarter adjusted earnings per share coming ahead of consensus estimates. Whew. Piper Sandler said this was an all-around positive update. We're talking Intuitive Surgical. Piper Sandler, Leerink, and Jefferies all raising their price target. Now to Canada Goose, up 2.5%. This one rallying after it was initiated with an outperform recommendation and a $21 a share price target over at Wedbush, which said the shares seem undervalued, which makes sense because the stock closed at $12.20 a share. And one more, Hawaiian Electric had to point this out, up about 37%. It's among the companies that have tentatively agreed to pay more than $4 billion to resolve hundreds of lawsuits over the wildfires that ripped through Maui last year. This is according to people familiar. So we saw, certainly, David, people moving into that one.
Yeah, absolutely. Talk about decliners. You got to mention CrowdStrike. Obviously, this is a huge story today, one that we all woke up to here on the East Coast in New York. The cybersecurity company suffering this failure that affected so many companies around the world. We saw that steep decline there. Mandeep Singh saying this is a company that has done so well for so long. It's just a total surprise, and we'll see what happens in the coming days as now the specter of potential lawsuits comes into play here. Who's going to have to pay the bills for what's happened here at airports and banks, all kinds of businesses all over the world. Comerica, that Dallas-based bank, reported earnings. Its outlook worse than Wall Street expected. We saw that bank shares decline as well. It's also being removed from a treasury program it had a contract with, a deal with, and not being asked to rebid for that. A huge problem for that bank. I should say it's also facing a lawsuit related to fraud allegations. So not in a great spot today. We saw declines there in Comerica's stock price as well. And finally, we've been talking a lot about politics, about the prospects for President Biden.
No, we haven't.
We have indeed, Carol. Former President Trump as well. DJT, of course, Donald Trump's Trump Media and Technology Group. He is the majority shareholder in that company. We saw declines there today, not attributable to what we heard or saw at the Republican National Convention in Milwaukee. In fact, having to do with the stock dilution, the fact that now there are going to be about $2.5 billion more shares available. That, of course, makes them worth less. Good for the former president, I should say. Maybe not good for other folks, but we saw DJT sinking today in trading on Wall Street, guys.
All right, let's take a look at what's going on in the Treasury space. Yields moving up, so price down, yields higher, the yield curve steepening as well. You can see the 10-year yield moving up 3 basis points. That's the same for the 2-year as well, 4.23%. Carol, what was interesting to me, and this is not limited to Treasuries, of course, was the computer outage that we got overnight and this morning. It affected bond trading as well since the start of the New York session. This is according to Alice Anders, who is our U.S. rates and FX strategist over for our Markets Live blog. So it feels like no corner of the financial world was kind of untouched, and the business world was untouched by this massive computer outage.
Right. David and I talked a lot about the airline industry. I'm sure you guys did as well. Some headlines crossing. Delta says 1,200 flights canceled Friday, so extending the waiver that they're giving to customers, it sounds like, and says more delays, cancellations possible through the weekend. The FTA also was saying that, right, as well, that they anticipated that some of this could carry over into the weekend. So we'll be keeping an eye. We talked with Helene Becker over at Cowen, and she said they're treating this like a storm event.
So fascinating, like a winter storm. That's the kind of disruption that we've seen here.
I mean, the reality of this issue, too, is it's going to last people into the weekend, right? Because you had that many flights canceled, and then a number of those flights being rerouted, and a number of those flights being, redone for folks. But many of these people will be sitting in an airport for a day or two, or the airport hotel.
Yeah, not from the airport that they departed from, and not from the airport, not at the airport that they want to get to, but somewhere likely in between. At the same time, you have companies like FedEx and UPS warning of delivery delays from this outage. What's interesting to me, of course, is we had the Amazon Prime days earlier this week. So there are people who are buying things off Amazon, expecting them to get them today or tomorrow, and that's probably not going to happen now because of the delays triggered by this outage.
All right, let's get to what really matters. That unbelievably, companies are considering what cocoa butter alternatives. Is there any alternative to cocoa butter? I don't think so.
Wait, instead of chocolate, you mean? Instead of cocoa overall?
I guess so. I guess they're coming up because cocoa butter prices are, what, $28,000 a ton?
We've seen the fallout from really weather events in Africa where cocoa is grown, and this has kind of been building over and over. There have been warnings about how much chocolate prices are going to go up, and I just love this piece on the Bloomberg. Niall Sands, president of a commercial development innovation alternatives maker, AAK, saying chocolate quite often is an impulse purchase, stating the obvious there, but one I'm guilty of purchasing
How many of you have walked out of the Bloomberg headquarters and to the right is this incredible chocolate store? I've done it. And eaten the chocolate before I'm leaving home.
I mean, the cocoa butter prices at near $28,000 a ton is just eye-popping at the end of the day. And you can see why people are looking for alternatives. So I do agree with you. I don't know what that would be.
I think it's really fascinating, David. I'm glad you brought up that quote because there was another quote in that story that said that they don't want to make chocolate a luxury purchase. They want to keep chocolate an impulse purchase, something that everyone has access to. And, people can walk out the drugstore and be like, oh, wait, hey, I need that 100-gram bar right now.
In an environment and like just being serious, right? We talk about inflation, right? And companies trying to figure out with still some of the higher input costs, they've got to figure out alternatives. Otherwise, they've got to raise prices to consumers in an environment, right, David? We were talking about this earlier in the retail sector where consumers are looking for value.
Looking for value, looking for deals. We saw it in obviously dining and restaurants first. Now we're seeing it move over to other products, other parts of retail as well. Buy 2 bars. If they're getting smaller, if there's shrinkflation, get 2 chocolate bars.
Like Twix.
Yes, that's right. Don't give it to a friend, have it yourself. Exactly.
All right, guys. What a week. What a day. We'll see what the weekend holds, but be safe. And we will see you again, same time, same place on Monday. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. We'll see you on Monday.
And we've got much more ahead. This is The Close on Bloomberg. Welcome back to The Close on this Friday. I'm Scarlett Fu.
And I'm Sonali Basak. We're going to take a look at where markets closed out the day. It was a tough tape out there. The S&P 500 really closed lower by 0.7%, but you saw more of that pain in the tech-heavy indices. That is the NASDAQ 100 down 0.9% today. The Philadelphia Semiconductor Index down more than 3% today. The Russell 2000 Index, remember, this is where the great rotation really happened this week, was down 0.6%, but was the one index that was really still up on the week. Scarlett, what were you watching?
Still up on the week. I'm watching what everyone else is watching, which is the global IT outage. And the culprits are pretty clear. CrowdStrike at the center of it because its software is at fault for triggering that massive failure. It spent most of today fixing a faulty patch that crashed Windows operating computing systems around the world. So clients ranging from banks to retailers to airlines to healthcare systems, they were all left paralyzed and in many cases had to manually reboot their systems. Now, Microsoft also caught up in all this as well, down 0.75%. It has rolled out fixes as well for its operating system glitches. By the way, this is the 4th day of losses for Microsoft, and the stock is now at a 5-week low. On the flip side, we did see gains in Intuitive Surgical, ISRG, up almost 10% on the day. Record high here for ISRG. The medical equipment company's fiscal second quarter EPS, adjusted EPS, topped analyst estimates, and Piper Sandler said this was an all-around positive report. But when it comes down to everything, our top story this hour and really this week is about the Democratic Party in turmoil, with President Biden now making plans to return to the campaign trail next week once he recovers from COVID. This is despite party leaders urging him to drop out of the race for fear of losing the Oval Office. The House and the Senate will be discussing the implications of all of that.
Ed Yardeni, president of Yardeni Research, weighing in on the election, writing, quote, as the likelihood of a second term for President Trump rises, so does the likelihood of an extension of Trump's 2017 corporate and individual tax cuts beyond 2025. In addition, the market expects several more rate cuts in the coming months. Those are 2 tailwinds for the stock market. Ed, of course, joins us now. And I want to talk more about that view in particular, because there is a view out there, Ed, that the tax cuts, if they are pursued to a greater degree in this environment, that could be inflationary alongside potential strict tariff policies. How does that compare with what people are expecting now for a rate cut? Would it mean more rate hikes ahead?
Yeah, I think that's a real concern, certainly. Trump's idea of extending the tax cuts might be stimulative, but again, it's really just an extension. It's not increasing the tax cuts. So I don't know that there'd be a material change in the way the economy operates. Quite the opposite. If the tax cuts were not extended, that might actually weigh on the economy and may require even more interest rate cuts. So the jury's out on that one. I don't think the jury's out on tariffs. I think everybody agrees that slapping more tariffs on all imports, let's say a 10% tariff across the board, obviously that would create some inflationary pressures. But what we've learned over the past couple of years is inflation is a very complex process, and it's not just one thing that affects things. I mean, right now we've got a situation where China is very depressed, and they are trying to keep their economy afloat by manufacturing more, exporting more, lowering prices on those goods, and that's actually been deflationary.
Yeah, all good points. I think about the Trump trade that kind of took off this week. Energy rallying, financials rallying on this idea that President Trump would reduce regulations on that sector, maybe encourage more consolidation, and of course a stronger dollar, even though he's in favor of a weaker dollar. What should be the Trump trade, do you think? Or should there not be a Trump trade at the moment because things are still so volatile?
Yeah, well, the past week's been kind of confusing ever since actually July 11th when the CPI came out and it was lower than expected. I think what we've seen is a rotation towards interest rate sensitive stocks. I think that was the bigger move. And at the same time, we had the Trump trade talk because of the assassination. He survived it. And the polls suggested that as a result, there's an increasing chance he'll be president. So everybody jumped on the Trump trade. But I think that what really stands out to me is the markets have come to the conclusion that the Fed's going to be lowering interest rates. It's the Powell trade. It's Fed Chair Powell has been fairly committal in promising that rate cuts are coming.
You know, you look at the rotation trade that's been occurring this week as well, and we were talking a little earlier about how even though the Russell was down, the Russell 2000 was down today, it wasn't down as much as the other larger indices in terms of how large the stocks were. How sticky is this rotation, Ed?
Well, I'm not that convinced that the mid caps, the small and mid cap stocks are going to continue to outperform. I think there was a lot of short covering in that marketplace. My problem with the smaller companies is their revenues haven't been growing for the past 2 years. Their earnings haven't been growing for the past 2 years, and they don't seem to be able to revive their profit margins. Not quite sure what that is. It may very well be that there's been structural changes among the mid-cap area in that, a lot of the really good companies get bought out before they ever go public. The Magnificent Seven have a lot of cash and they buy the good companies before they go public. So I think the market is broadening. I think it's broadening from the Magnificent Seven to the S&P 493, all the other stocks that have been left behind.
Yeah, absolutely. Being cheap is not enough based on what you said, because you need to see that growth on the top line, you need to see the growth on the bottom line and in profit margins as well. When we look at what happened this week, bank earnings, we saw the wrap up of big bank earnings, and of course we saw the beginning of the regional bank earnings. What did you learn from the financials reporting that we can apply to the rest of the economy?
Well, first and foremost, I think the message from the banks was that the consumer's in pretty good shape. That, delinquencies have gone up, but it's kind of gone up back to normal. Following the great financial crisis back in 2008, and then with the great virus crisis, consumers turned really quite conservative. They refinanced their mortgages. They've been careful with the amount of consumer debt they've taken on. And now what we're seeing is maybe the consumers are feeling a little bit more relaxed about things. And things have normalized. It's not as though the consumer is suddenly going to drop out, which is, I think, the main point, the main story I learned from the bank report conference calls.
What about other sectors here? You had banks that were pretty favored this week in broad strokes. You also had the Russell, we already talked about that. But the Mag 7, when you think about the roughly 5% drawdown that they had this week alone, what does that set you up for heading into next week with so much uncertainty around earnings?
It's hard to get really that upset about a drop like that after the kind of run that these companies have had for the past few years. And they're still in great shape. They don't depend on borrowing a lot of money. They have a tremendous amount of cash flow. These are huge companies that are able to generate double-digit earnings growth, and they are, as I said, they're able to use their cash to buy up more smaller companies that have all sorts of innovations that they can leverage up into into bigger markets. And I think they certainly have an advantage in artificial intelligence. And there's some hype in artificial intelligence, but there's so much money is being spent in this technology that it's bound to have a positive impact on earnings at some point. And I think the large caps are likely to see that sooner rather than later relative to the mid caps.
Yeah, I love the at some point down the road. It's just a matter of at what point investors will demand for that to show up. Ed Yardeni, thank you as always. Ed Yardeni is president of Yardeni Research. Coming up on The Close, the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close.
Season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing
earnings out of Broadcom.
JP Morgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is venture capitalist Mark Stevens. He was early to invest in NVIDIA, starting in 1993 when he was a new partner at Sequoia Capital. And as a result, he has amassed a nearly $9 billion fortune. It's been a bumpy ride, Sonali, but it's really paid off over the last year and a half, 2 years?
I'm sure that his stake in the Golden State Warriors is also not hard to swallow for him as well. But yes, NVIDIA certainly sticking with that one really did help him out at the end of the day. And you can see those riches go a long way.
Yeah, and he's now on the Bloomberg Billionaires list as well. If you hit Rich Go, type Rich Go on the Bloomberg terminal, you'll find his name on there.
A lot of fun things to find there. But beyond that, I am watching Bella Hadid. Adidas pulled advertising images of the model promoting a shoe that first launched in 1972, the year of the Munich Olympics, according to the Financial Times. And of course, this is a very politically heated story.
Yeah, because 11 members of the Israel team in 1972, you'll recall, were killed in an attack by pro-Palestinian militants. And Hadid's family has roots in Palestine, and Israel has accused her of anti-Semitism. So as a result, Adidas has been facing a lot of backlash using Hadid in its imagery.
And it's not the first time that Adidas and somebody supporting Adidas here, being championing of the shoes here or other products, also being accused of anti-Semitism.
Yeah, Yeezy did not work out so well for Adidas, so.
Tough blow for Adidas.
All right, rounding out our top three is Mark Zuckerberg. The Meta CEO praised former President Donald Trump's response after being shot as inspiring. Actually, he used another word, badass. Let's take a listen to more of what he told Emily Chang of The Circuit.
I want to talk about the 2024 presidential election.
Okay.
Facebook has been a flashpoint in many elections around the world, and you personally have been called out, most recently by former President Trump. This is a big election. What do you think is at stake?
Well, I mean, look, it's obviously a very important, and it'll be a historic election. I feel like I'm best positioned maybe to talk about what our role will be in it and what we're going to do. And look, I mean, the main thing that I hear from people is that they actually want to see less political content on our services because they come to our services to connect with people. So, that's what we're going to do, where we give people control over this, but we're generally trying to recommend less political content. So I think you're going to see our services play less of a role in this election than they have in the past. And personally, I'm also planning on not playing a significant role in the election. I've done some stuff personally in the past. I'm not planning on doing that this time. And that includes, not endorsing either of the candidates. Now, look, I mean, there's obviously a lot of crazy stuff going on in the world. I mean, the historic events over over the weekend. And I mean, on a personal note, it's, seeing Donald Trump get up after getting shot in the face and pump his fist in the air with the American flag is one of the most badass things I've ever seen in my life. But, and I think, look, at some level as an American, it's like hard to not get kind of emotional about that spirit and that fight. And I think that that's why a lot of people like the guy. But look, I mean, we're living in a pretty crazy time. And I view our role here is to make it so that everyone can express their views on this stuff. But we're going to try to manage it so that way the politics doesn't drown out the human connection and the community, which is, I think, the main thing that people come to our services for. And, we're not always going to get that right, but that's what we're going to try to do. And I think that that's probably the best role that we can play.
That was Mark Zuckerberg, CEO of Meta, speaking with our Emily Chang of Bloomberg Originals. He said, Shonali, that he's not planning on being involved in the election in any way, but his company already is, right? Meta removed all heightened penalties on Donald Trump's Instagram and Facebook accounts, meaning he's really no longer on probation. There are no restraints on what he can post. For a while there was, because he was suspended, then he was brought back, but they always kept that option of, if he violated any of Meta's rules, they would yank him again.
Yeah, if you like it or not, I think in social media these days you are involved in the political discourse, of course. Interestingly enough, Meta was actually up today, one of the only Magnificent Seven stocks that were on the rise. And you have to wonder if part of that is a warming tone here coming out of Zuckerberg and the Trump administration. Coming up next, we're going to talk about something else. Businesses across the globe grapple with the aftermath of the IT failure that grounded flights and upended the markets. Businesses disrupted across the globe. Stick with us. We'll talk more about that next. This is The Close on Bloomberg.
Businesses across the world are playing cleanup after a botched CrowdStrike update disrupted Microsoft systems, causing a massive IT outage. Joining us now with more insight on how Microsoft has been dealing with this is Ann Johnson. Ann is Corporate Vice President of Security, Compliance, and Identity Business Development over at Microsoft, which means she has been super busy today. So, Ann, we thank you for your time in joining us. I was looking at your bio, and you've been a Microsoft security executive since 2015. Have you ever had a day like today?
Unfortunately, yes. Today is unique, though, in that complete empathy for our customers, right? There's a global IT outage. It was caused by this CrowdStrike update. We are working with CrowdStrike. We are working with customers. We have a ton of engineers, a ton of support people, and our focus is getting people back online as quickly as possible. It's one of those really difficult days in tech because it's a lot of work, right? And all of us need to lean in together. I will tell you the thing that makes me the happiest is that the industry has leaned in together. So we have difficult days, as you know, in the industry. We have difficult days in technology. We have had other days that have had global impact. But to see everyone coming together and working together to get customers and that focus completely on getting customers back online, it's really been great.
Yeah, I'm sure that is. And that's a part of the rewarding parts of your job, as well as dealing with the headaches that come along with it. Give us a sense here of what it means for companies that do rely on Microsoft Windows operating system that were not affected by the outage. Why were some companies or some customers spared when others were hit so hard?
Oh, sure. You had to be actually a CrowdStrike customer and this specific CrowdStrike solution, right? The customers that were impacted were customers that had this CrowdStrike solution. They actually installed this update, and then they found the update was flawed and it impacted their systems. If they were not a customer or they had not patched or done the update yet, they would not have had this type of impact.
I do want to understand where the problem starts and ends, because there are certain things that were related to CrowdStrike and therefore in a second degree related to Microsoft customers as well. But then there was an unrelated issue when it came to Azure as well. How do you describe what exactly happened and where CrowdStrike's actual responsibility was and where yours was?
Yeah, so yesterday we had a very short-term Azure impact that impacted a small region of the United States, and certainly it impacted customers, and we always want to pivot to getting customers back online as quickly as possible. That incident was completely mitigated very quickly. We brought customers back online. In parallel, completely unrelated, was CrowdStrike issued this patch This patch, unfortunately, was flawed. Customers who installed this patch were impacted. They were not able to get their systems back online. It was a global IT outage, as you know. So we have been working with CrowdStrike. We've been working with our customers. This has the visibility of Microsoft's most senior leadership team, including Satya Nadella personally. And we are bringing to bear every resource we can to work both with CrowdStrike and also to work with customers to make this as easy for customers to get back online, but as quickly to get them back online as possible.
And I understand that the first order issue here is to get everyone back online, but in a day, in 2 days, in 3 days, you're going to have some businesses that turn around and say, you know, there were thousands of flights that had to be canceled, and there was business that was disrupted because of this. Where do they go? How do they get their money back?
I am not even equipped to answer that, to be candid with you. I'm here because I'm deeply involved in the event, deeply involved in getting our customers technically back online, and deeply involved in then thinking from here, how do we continue to work with our partners to build a robust ecosystem so we don't have these type of failures in the future.
Fair enough. Give us a sense of the scale of the problem. At its worst, how widespread was this? What percentage of your customers were affected, and what has that come down to now?
It's super hard for us to actually give you a scale because these were actually CrowdStrike customers that were impacted. And they were CrowdStrike customers who also happened to use Microsoft systems. But CrowdStrike would definitely have a better view of what the scale was of the percentage or the number of their customers globally that were impacted. We just recognize that there was a lot of global impact with the very large enterprises. Mm-hmm. And we want to make sure those large enterprises and their consumers, right, don't continue to be impacted.
Okay, so you're kind of dealing with the after effects here, is what it sounds like you're saying. On your end, how do you prevent this from happening? What can Microsoft do to prevent this from happening? I know that the issue began with CrowdStrike, but because it affected Windows, what do you do on your end?
Yeah, it's a great question. Right now, and I've said this, and I think it bears repeating, our hyper focus and our laser focus is getting people back online as quickly as possible and working with all the teams that we have and working with CrowdStrike as a partner to do that. Moving forward, there will be plenty of opportunity to think through how we work with our partners, to think through how we build a more robust ecosystem, because at the end of the day, all of these technologies are interconnected, and we have to make certain. We have testing. This isn't taken lightly, right? We test with these partners. They test these patches and updates. Obviously, something happened here that should not have happened, and we will have plenty of time to focus after the event on what we can learn from the event and then what we can put in practice post. But right now we are just laser focused on getting people online.
And that was absolutely going to be my next question. At the end of the day, there are a lot of people asking, isn't this routine testing? Shouldn't this have been tested? And at the end of the day, does this change your relationship with CrowdStrike?
No, it doesn't change our relationship. It perhaps brings us even closer than we've been. We already have rigor around these programs, and we will look through this program that we had in place and just see where we could have done better, where we could have improved, and we will do that collectively and do that together. And we will then publish those learnings out to the entire ecosystem so everyone can learn from this event.
All right, Ann Johnson, really appreciate your taking the time to speak with us. Ann is Corporate Vice President of Security, Compliance, and Identity Business Development at Microsoft, playing a big role, a big frontline role here in cleaning up the global IT outage following basically a patch issue with CrowdStrike that then infected Windows operating systems as well. In terms of the impact on the markets, Shonali, when I got in this morning, it definitely felt like this cast a pall over the markets in terms of sentiment. And we did finish lower as well, as markets did not rally into the close as they had been in weeks prior. They kind of swooned into the close.
Well, it's so interesting. So much of the trade overnight impacts the trade into the day and trade throughout the day. And when there were hedge funds sitting there unable to trade,
yes,
and banks unable to service
in Asia,
their hedge
in Europe,
funds
yep,
overnight, it's a tough way to start the day, particularly when the risk appetite this week towards the tail end of the week was not so great.
Absolutely. Although it's worth noting here that the Russell 2000 did better than the big cap brethren, down 0.6% and outperforming on the week. Certainly a big gain there. For the big indexes, it was the worst week since April, and the VIX goes up to 16.5. This is the close on Bloomberg.
And And what a week it's been. As Republicans wrap up a week in Milwaukee for RNC, with Donald Trump officially accepting the nomination, the Democrats are scrambling to find cohesion before their convention in Chicago next month. President Joe Biden is vowing to stay on the campaign trail despite a growing list of Democrats and prominent donors calling for him to drop out of the race. And joining us now from D.C. with his perspective on the presidential race is Terry Haynes, founder of Pangea Policy. And when you think about the Biden part of the story now and the calls that have been under the surface or loudly, frankly, for that matter, for him to step down, what does this say at this point about the Democratic Party, Terry?
Well, fundamentally, I've been saying since the debate that Biden didn't have to get out, and in fact, he wouldn't get out, and so far he hasn't, and because nobody can make him, basically. Number one. Number two, the people, the Democratic leaders who allegedly want him to stand aside, don't have yet enough courage of their convictions or enough certainty to say so and do so in public. So what you've got is a what used to be called a circular firing squad going on, metaphorically, where everybody's thrashing around at each other and nobody's paying attention to the campaign or what they need to be doing to defeat Donald Trump. So, you've got a very distracted group that right now is more interested in their own positions within the party than actually taking the fight to Trump.
Okay, that's fair. I'm curious, as we look at pictures of President Biden and Vice President Kamala Harris, what is going on inside Team Harris? Because the New York Times is reporting that the Vice President is speaking with major Democratic donors this afternoon, set to address a number of them, and it's not clear exactly what's on the agenda, because many of them do hope she'll be the nominee, and we know that she's been very, very firm in saying that she supports the president. What are you looking for to come out of this phone call?
Oh, probably not very much. They'll all talk about how they want to support the president and whatever he decides to do, which is the euphemism for "please, please get out," and all the rest. And otherwise they won't say anything in particular. And the vice president, I think, for her part, will be loyal on the outside and trying to get ready on the inside, because she's not going to know what's going to go on. It's not like Team Biden's going to give her a big heads up either. So she's likely to be, if there's a decision to be made by the president, she's likely to be as surprised as anybody else when it happens. And she won't know whether that decision has to do purely with the nomination or has to do with the nomination and Biden being president, which, I think is the vast majority of voters think is a more important thing as opposed to the nomination.
How does she get ready, Terry?
Well, she's going to have to figure out kind of strategically, tactically, she's going to have to work to consolidate as much support as possible, firstly. Secondly, she's going to have a short list of potential vice presidential candidates in her head to be nominated with her. And thirdly, she's going to have to figure out how to step out of Biden's shadow and actually figure out the issues on her own that she thinks and her team thinks are the most important issues and can do the most damage to Trump and even out the race some more. So those are three must-dos. Doing them all at the same time is a pretty big lift.
I'm looking at predicted markets right now. This idea that there's a 65% chance that Donald Trump will win the election, a 28% chance for Kamala Harris, and a 13% chance for Joe Biden. And Terry, you pointed this out in your note a little earlier. Describe the difference between what betting markets are seeing and what polling is saying.
Well, betting markets are as they're advertised, what they think is going to happen months from now. And all I can tell you is that what prediction markets, what betting markets think is likely to happen is very different than the political reality on the ground, where the race, whether you look at it nationally or in the swing states that are all that matter, are very tight. And not irretrievable for Biden or anybody else that might run in the Democratic side. One observation I would make about the Democratic Party is that it's selling itself these days almost as an institutional party. If you are for this list of things, whether it be social issues, economic issues, whatever, you should be for us, and regardless of who the presidential candidate is. And, and they're kind of preparing in that direction, should there be a change at the top.
What do you think about the tone of the Democratic Party after the RNC this week? You thought about kind of this week alone and how much Trump stole the stage with so many new announcements that we had seen this week alone, really a lot of rhetoric around the policies that he's putting in place, and then the overlap there is in some of those policies actually with the Democratic Party. Where is the Democratic Party going to most differentiate themselves going to the ticket? Is it meaning that Biden will have to go further left?
Well, sure. What they want to do. I mean, there's sort of the way I would answer this is there's a kind of a iceberg above the water and below the water. Above the water is kind of opportunities on social issues, and they've been preparing for that for some time anyway. But what they're doing is doing a full bore push on social issues, and in the bargain, not only discrediting Trump and the Republicans in the strongest possible terms, but even going out and attacking the Supreme Court, attacking institutions of government themselves in order to try to make their point. But what's under the water is troubling, and it's not quite apparent yet. But the Democratic Party, kind of all this thrashing around about whether Biden ought to continue to be the nominee or not, is actually hurting the Democratic brand quite a lot. People I talk to in Washington, people who are actually on these campaigns, say to me, look, I don't think the Democrats understand, or if they do, they don't care about how much their brand is being hurt, because voters are starting to look at them as people who weren't telling the truth about Biden, aren't telling the truth about Biden now, and aren't telling the truth about lots and lots of different issues. So, that perception starts to take the place of whatever it is that their message against Trump is. So it's a very difficult, and self-created situation to some extent.
Yeah, airing a lot of dirty laundry right now in front of the public. So we're about to enter the fourth weekend since the debate that started it all, where everyone's on Biden watch to see if something will happen, whether he's going to perhaps step down from the ticket. You don't see it happening this weekend. What do you think will happen next week, Terry? What do you see transpiring?
Well, look, there's two. The way I would put this, Scarlett, is really it's very simple. People just need to look for two things. There is a virtual nomination that's supposed to take place. That would take up the next segment of your show to tell you why that is. But there's a virtual nomination that's supposed to take place sometime within the next couple of weeks. I would look for that to see if that goes through, or if that's delayed further, or if it's scuttled entirely. Because if it is, then that's a warning shot to Biden that things aren't going to go smoothly at the actual convention. And then secondly, regardless of what happens with number one, you get to the actual convention. And I think what happens is that the folks that don't want Biden to be the nominee have to have a rules fight at the convention, an old-fashioned rules fight, where they let the delegates basically off the hook in voting for Biden and free them up to potentially vote for somebody else. That's going to play out over the next few weeks, but I don't think I'd look for anything this weekend. The president's still very much in defiant mode, but if his opponents are serious, you will see both of those scenarios start to happen.
All right, good stuff. Terry, really appreciate your take. Always, always lovely to get your insight. Terry Haynes, founder of Pangea Policy. He doesn't see anything happening this weekend.
Remember, the president still has to get past this COVID episode as well. And so, busy week ahead is what I would say.
Yeah, and he plans on campaigning next week. That much he's made clear. All right, still ahead, Shonali mentioned it, what we need to watch for next week. And, of course, a lot of big tech earnings on the calendar. This is The Close on Bloomberg.
Tech earnings kick off next week. Alphabet, Tesla, Spotify, all reporting Tuesday. Mandeep Singh of Bloomberg Intelligence joins us now, as if his day was not busy enough covering CrowdStrike and Microsoft and this global IT outage. You think about next week, the setup into next week, and how much uncertainty. Which of the parts of your universe that you cover have the most potential for upside or downside swings
Yeah, I mean, for me, it's Alphabet. Look, they are among the mega cap that are trading at a reasonable valuation. When you compare it with Microsoft at 34 times PE, Alphabet is 23 times PE. And look, the setup is really good here because everyone thought they're getting disrupted with ChatGPT. Last quarter, they printed great search numbers. I think they're going to beat consensus numbers again. And YouTube, I mean, what we saw with Netflix was subscriber ads were good. They were weak on the ad side. That's where Alphabet will do very well with YouTube. And cloud business, look, all these companies are accelerating their CapEx spend. We know they're raising it by 50%. That will show up in the cloud numbers.
Scarlett, people want to watch TV.
People want to watch TV, myself included. Thank you for that shout out. In terms of what you expect to hear from them on AI. Every quarter, every executive jams their earnings release and their earnings call with as many mentions of AI as they can. When do we start to see that actually result in actionable numbers for them, revenue or bottom line?
Actually, they have the biggest product out there that incorporates AI. If you think about how the search page is evolving, they're incorporating Gen AI overviews. That's all LLM driven. So they're actually deploying their AI in a big way. And when we think about, what ChatGPT gives you in terms of results, they're incorporating that in search. So I do think they are deploying it at scale, and it's making a difference in their engagement.
It's going to show up in the number of views or the number of clicks?
In the engagement and the ad volume and the ad revenue. So I do expect a beat in the core search business driven by the search generative experience and the Gen AI overviews that they rolled out.
I know this is a little bit off still relative to what we have next week, but when you think about Microsoft and what you saw today, is this IT outage going to in some ways overshadow earnings?
Well, so it comes down to valuation. All these companies are great. They've got very good fundamentals, but there is a price investors want to pay for owning Microsoft or owning Alphabet. In the case of Alphabet, no one even talks about Waymo yet. But when you think about what they could potentially do with Waymo on the driverless side, that's an optionality. So there are a lot of businesses within Alphabet that are actually working very well. And there's a lot of upside that you can see down the line. I mean, it may not show up in the next 2 quarters, but clearly they are set up very well.
All right, Mandeep, really, thank you so much. You set us up very well, and we'll be coming to you for your expertise in the days to come with all the big tech companies starting to report earnings beginning with next week. All right, let's look at what else is on tap for next week. Looking at the calendar on Tuesday, Shonali, the Senate and the House return from recess. It doesn't really feel like they've been away because there's been so much chatter with regards to what happens with President Biden and the RNC. Obviously, a lot of excitement around the formal nomination of former President Trump as the nominee for this election.
Certainly everything every senator has had to say in the House and in the Senate has been very closely watched, given how divisive this election cycle has been. But also remember, in addition to the presidential elections, a lot of investors are watching out what a red wave would mean for the stock market. So yes, we will be certainly watching Congress cards.
And of course, earnings, as we mentioned, yes, you've got Tesla, yes, you've got Alphabet, but you've got a sampling of companies from a whole bunch of other sectors, including UPS, including General Motors. I think about some of those companies, and definitely what's on tap is cost considerations, right? And how they're managing costs.
Ford as well, if you think about it. And it's interesting, you'll get a deeper look into how that consumer is behaving in this part of the cycle, especially for goods more expensive like cars. But also if you think about UPS, this outage was after the quarter. And so you also want to look out for that commentary on how other things might be affecting these companies into this season.
And we've got Benjamin Netanyahu addressing Congress on Wednesday, so a lot of fireworks, I'm sure, in Washington, perhaps also a lot of protests, I would expect, around town as well. And then economic data on Thursday, including the first read of second quarter GDP coming out.
Remember, the bond market was moving pretty intensely this week, particularly to start the week. And you have to wonder, at the end of next week, we have US PCE, the Fed's preferred gauge of inflation, University of Michigan sentiment data. And next week is another busy one. Rest up, people.
Also, the Paris Olympics begin next week.
Oh, I didn't know that.
Yeah, so a bit of a reprieve.
Where have I been?
No, you've been busy covering the outage in the markets. That does it for us. Have a great weekend, everyone.